If you have ever looked closely at a chart with the price of an asset, you may have noticed that the price always seems to move in a particular structure. Despite the randomness of the market, it's often the case that the price moves in a particular pattern. A large reason for this is liquidity. Liquidity is what moves the prices of assets. Therefore, knowing what liquidity is allows us to decipher the market, which can lead to extremely profitable entries. It's first important to understand what liquidity is. Liquidity refers to the ease with which an asset can be bought or sold in the market without affecting its price. In other words, it measures the ability of market participants to enter or exit a position in an asset quickly and at a fair price. Market depth also plays an important role, so it's crucial to understand what it is. Market depth refers to the quantity of buy and sell orders at different price levels for a particular asset. This can usually be seen in the order book. It shows how much demand and supply there is for an asset at different price levels, and how many shares or contracts can be bought or sold without significantly moving the price. Liquidity hunts are one of the most common phenomena in the market that cause retail traders to get stopped out of positions. To avoid liquidity hunts, we will first need to understand why and how they occur. To explain this, let's use an example. Here we can see that the price action was in a downtrend, however the price has rejected of this support zone twice, creating a double bottom. Along with this, a bullish engulfing candlestick was created. All of these signals indicate it's a good idea to enter into a buy position. We will be placing the stop loss at the support point. Now let's see how the trade plays out. As you can see, the trade ended up going in the right direction. However, the support point was broken and therefore we were stopped out of the trade. This happens because many other traders also place their stop loss at this level. This allows the smart money to take the liquidity provided by these stop losses being hit to enter into a large position without incurring any slippage. There are 3 methods to avoid these liquidity hunts. The first method involves finding stop loss orders. Areas in the market where stop losses are hit will usually be targeted. Smart money knows that the simplest and most obvious pattern will have the most retail stop losses. This means that patterns that use horizontal support and resistance will usually be hunted. Therefore, if it's likely that a liquidity hunt may occur, we should place the stop loss at a different support point. So in this example, instead of placing the stop loss here, we would place it here, avoiding the stop hunt. If we take a look at how the trade plays out, we can indeed see that by placing the stop loss at a less common point, we avoided the liquidity hunt. With the second method, we will be avoiding round numbers. Many retail traders often place their stop loss at a whole number. In this example, we can see that the price wicked just below the $4,000 price level before bouncing back up. This is because many of the retail traders place their stop losses at these points. The final way of avoiding liquidity hunts includes using an indicator to determine the rhythm of the market. By using an indicator such as the ATR bands with a 3 times multiplier, we can see that the previously shown liquidity hunts were completely avoided. This is because the ATR takes into account the volatility of the market. After a liquidity hunt, we will usually see a sharp move into the original direction of the trend. Knowing that these liquidity hunts occur, we can use them to enter into positions, allowing us to trade with the smart money. But before that, if you are looking for a crypto exchange that currently has some of the lowest fees when it comes to futures and spot trading and up to a $30,000 bonus, then check out the link in the description of the video to get access to all of these perks. Here we see that a resistance level turned into a support level. The price action tested the level multiple times. Since we are looking for a liquidity hunt, we will wait for the smart money to push the price down below the support level so that the stop losses of the retail traders are hit. Once this happens, we will enter into the position as soon as we see a sharp move that follows the original bullish trend. As you can see, by using this method, we can trade with the smart money. In order to be able to enter into positions, it's important to first find liquidity levels. However, finding these levels can often be confusing, so let's add an indicator to the chart to help us find these levels. Head over to the Indicator Search tab and search for the HTF Liquidity Levels indicator. Select the indicator made by SBTNC and add it to the chart. Now head over to the indicator settings. Since we will be looking for short to mid-term liquidity levels, we will be selecting only the daily and the 4-hour levels. Finally, to make the indicator more visible, we will be changing the opacity of the levels. That was all that we needed to do. Before we start using the indicator, let's first understand how the indicator works. The indicator helps us find 3 different liquidity concepts. The first liquidity concept showcased by the indicator is the liquidity levels, which are the previously discussed key areas where resting orders accumulate, for example in the form of stop-loss orders. If the level is reached, then this means that the level has been tapped. This will be shown in the form of gray dashed lines. The final concept is liquidity pools. A liquidity pool is created when there are multiple liquidity levels forming a cluster. These clusters act as magnets for the markets, meaning that the price will gravitate towards these heavier pockets of liquidity. If we draw boxes around the areas where we can see the most amount of liquidity levels, and look at how the price action reacts to these levels, we can see that the price indeed gravitates towards these levels. It's also important to note that the higher timeframe levels will have a larger effect on the price action than the lower timeframe levels. Since the highest timeframe we currently have enabled on the indicator is the daily level, let's change the color of it to help us identify it better. Now that we know what liquidity concepts are and how they can be used, let's take a look at some entries that can be made by utilizing these concepts. We can see here that the price made a large bearish move. After this bearish move was made, the price found support at this zone. If we take a closer look at the price, we can see that multiple pullbacks were made to the support zone. Due to the retest of the support zone, it may seem like a good time to enter into a position. However, if we look at the liquidity levels, we can see that there is a bearish daily liquidity level that hasn't been filled yet. Since it is common for the price to be attracted to the nearest level, let's first wait for the liquidity level to be filled. As you can see, the liquidity level has been filled. This indicates that the smart money has made its move, making it likely for the price to start going in the upwards direction now. So let's enter into the position. We will be placing the stop loss slightly below the recent swing low. For the take profit, we will be targeting the nearest daily liquidity level, aiming for a risk to reward ratio of at least 2. Now let's see how the trade plays out. If we take a look at the trade, we can see that the price moved perfectly to the liquidity and headed back down, before making new highs. Here we can see that the price has been in a large uptrend. We can also see that the price is respecting this resistance level. If we take a look at the liquidity levels indicator, we can see that there is a liquidity level that the price is moving towards. There is a high chance that smart money will first cause the price to move upwards and take the liquidity at this level, causing for all of the retail traders that place stop losses below it to be liquidated, providing even more liquidity to enter into a large position. So let's first wait for the price action to reach this level before entering into the position. As you can see, the price reached the daily liquidity level. Now let's enter into the position. We will be placing the stop loss slightly above the recent swing high. For the take profit, we will be targeting a liquidity level, aiming for a risk to reward ratio of at least 2. Now let's see how the trade plays out. As you can see, the trade was very profitable. We again see that right after the level was reached, the price made a sharp move in the opposite direction. I hope this video could help you with understanding what liquidity is and how you can use and utilize it in your own analysis. If you enjoyed the video, please leave a like and subscribe to the channel. If you have any questions, feel free to leave a comment.